I'm just gonna say it. Holy shit. Tom Lee just went on CNBC and reiterates his call for a 50% rally in the Russell 2000 by the end of this year. I don't think anyone saw that one coming. Because last time I checked, we only have 4 months left, and that would be one of the most aggressive rallies you have ever seen in the history of the markets, if not the most aggressive rally ever.
To come, Tom, never mind the unwind of the carry trade, and no one really knows whether that's over either. But when you think about those two events, what does it make you think about where we could go moving forward?
Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday, and a lot of it came from Texas. Texas had a big drop in weekly claims week over week. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds, and next Thursday they'll get another weekly claims number, and if that's also equally improving or stable, I think it's going to give people a lot more conviction.
What about the unwind of the carry trade? I mean, there's no real tell as to whether that's run its course, and that seems to be, the obvious catalyst at the beginning of the week for positioning being well off sides, and it just needed to correct itself. Has it finished?
Scott, that's a great question. Nobody knows how big that carry trade could be. I think there is a large insurance industry participation in that, and I did speak to some insurance executives this past week. As their view is, there's a lot of financial institutions that actually implemented this trade, but if it unwinds in an orderly way, it's not disruptive. It's just that if you have weeks or days like Monday or last week, the end of last week, that's very disorderly, and that gets very expensive because these insurance companies have to take off these hedges, and then they suddenly have unhedged carry trades.
Well, I just want to continue this. You suggest, if it unwinds in a messy way, there's no if. I mean, we saw at least the first reverberations from that unwind, and that was anything but orderly. What if there really is more of that to come, Tom?
Scott, there may be more of it. I think one thing that is been messy is the currency hedges, because these currency hedges were built for what you'd call like 1 percentile events, 99 percentile standard deviation. So a bigger move than that is what makes these hedges so expensive. They just let them expire. I think central banks can manage currencies within a 1 standard deviation band. So I think it's still important to watch currencies, but if we're staying in stable and predictable ranges, it can be a orderly unwind. But yes, Scott, that's an uncertainty, just like the Middle East is an uncertainty as well. But markets climb a wall of worry.
Yeah. What do you make of how this week began? Not with necessarily the market upset, but the commentary around it, whether it was Jeremy Siegel of the Wharton School suggesting the Fed needs to come out and do a 75 basis point cut in an emergency way. Of course, he walked that back with our own Jeff Cox yesterday evening. Ron and Son at the beginning of the week suggesting the Fed needs to come out and say something that essentially we've got your back from a liquidity standpoint. Do they need to do something before September's meeting?
Scott, I think both comments from both Ron and Jeremy Siegel are actually valid, but to me, what it speaks of is I think the markets and I think economists are no longer willing to deal with data dependence. I think they want a Fed that's more forward-looking, because that makes them comfortable the Fed could respond if conditions deteriorate. I think that's the kind of language I'd like to see disappear, is we're data dependent, so that by necessity they're going to be very late. I think it's actually encouraging to see this sort of pushback.
But when you say the concerns from Mr. Siegel are, in your words, valid, you're suggesting that you agree that the Fed needs to come out and make an emergency cut between now and the September meeting?
I don't think the Fed needs to make the cut, but I do think the Fed should, in their playbook, be willing to be forward looking to respond to financial instability. And I think that that's not language that's been evident in the FOMC meetings or the press conferences and in the minutes. And so I think it's kind of in the right direction, that I'd like to see the Fed less data dependent.
But I mean, isn't that implicit though, right? I mean, if there's the kind of dislocation perhaps that you're alluding to, that's part of their job. I mean, wouldn't they be there in an emergency situation anyway? And I don't know that Monday rose to the level of an emergency situation. It was the first bit of major upset that the market had felt in an awfully long time, and people were at the top of the mountain asking for help.
Scott, it's a fair question, but we know the Bank of Japan felt compelled to speak. I think markets would feel a lot better if there was a sense that global central banks were monitoring the situation. I think there's different levels of forward-looking communication that can be made, which is we're not necessarily going to act, but we're prepared to act. And I think that's what some of these outcries were really pushing towards.
Speaking of the worst being over, mega cap declines off the recent highs as I look at the list here. NVIDIA's down 26%, Amazon's down 16.5%, as is Alphabet, Microsoft about 13.5%, and Apple and Meta are also down, not quite as much as those. Would you suggest that the worst is over in that reset as well, or not?
I think it depends on an investor's time frame. The AI and the capital expenditures needed to really make up for this global labor shortage, and the fact that these mega caps like NVIDIA is trading at 25 times forward 2025 earnings. I mean, these are not expensive stocks where you have to worry about your risk reward over the next 12 months. But will there be a rotation if the Fed begins a cutting cycle that involves 4 cuts this year or 5, depending on what the futures markets are predicting? To me, that's very bullish for cyclical stocks and small caps and things that are money supply sensitive. So I think there is still a rotation risk, but I wouldn't be a seller of any of these mega caps here.
You just said small caps, which is a good segue for me because I wanted to go there anyway. Of course, your call with me months ago that the small caps could be up 50% this year. The Russell's up 2.5%, year to date. You want a mulligan on that? Do you still feel like you've got tremendous upside, but maybe not as much as you once thought? How would you characterize it yourself?
Well, we're still very constructive on small caps. I think the upside is at least 50%, Scott, because they're trading at 10 times, the median Russell 2000 stock trading at 10.7 times forward earnings versus more than 17 times for the S&P for 600 basis points faster earnings growth. But the timing hasn't worked out. I think small caps really shine when the market believes the Fed is going to cut because it provides so much relief to companies that have high cost of money, whether it's biotech, financials, industrials. I think it's a real saving. It's a lifeline for reducing the cost of money for consumers, which helps the banks. You have huge exposure in the Russell. So I think when the market believes the cuts are imminent, or maybe it's September, I think that's when the small cap call works. I think, we've been wrong on the timing. I would like to have seen us to be up 20% at this point, but I still think 50% could happen before year end.
Wow. Before year end. All right. You stick to your guns. Let's expand the conversation, Tom, if we could, and bring in Bryn Talkington of Requisite Capital Management and Young Yu Ma from BMO Wealth Management. It's good to see you both. Bryn, you want to weigh in on that? I mean, Tom's still really optimistic. We could start with the small caps just because that's the wow moment, I think, that we still could do 50% between now and the end of the year.
So I've been talking about this all year and really explicitly, I don't like the Russell 2000. So we'll get to that in a second. If he's right and we were to get a rally of that magnitude in small cap, what that's going to tell you is that, yes, we did have a soft landing. Yes, economic growth is happening. And so I think a lot of things would do really well. And so I think in order for small caps to have this type of rally, you need to have a soft landing, and then we need to continue to have economic growth. So that would be wonderful, by the way, if that happens. And I definitely think if that happens, he's correct. Where I get challenged on that is I do believe in the economic cycle. I do think we're slowing. I think the jury's out if we're stalling or not. I 1,000% agree with Tom. He said last week about Hurricane Beryl, he thought did have an impact on the unemployment numbers. And I can tell you, I live in Houston. There's 6.8 million people. There were over 1 million people that were out of companies, businesses, people out of electricity and internet for 2 weeks. I feel definitively it had an effect. And that's really where we started to see the market get dicey, is last week when that unemployment, and then obviously we had the black swan of the yen carry trade, magnified everything. But I think that we are slowing. I'm not in the camp that we're necessarily stalling. And so that's why I would rather own RSP, which is the equal weight, or maybe you could go to mid cap. I just think you have to thread the needle economically for small cap to really have a meaningful outperformance this year.
It's a good point because, Tom, as you say, small caps have a high cost of capital. We obviously would agree, so that a drop in interest rates would certainly help. But they do, as Bryn said, have a high risk of upset, if you will, in a slowing economy. And there is, I don't think, any doubt that the economy is slowing. It's just the degree to which it is.
I think Bryn is correct. If there is a recession, equities are just going to do poorly. So that if that is someone's base case, it is going to be really tough to see stocks outperform in the second half. I think we're in a more resilient economy than consensus has priced in. I think that's why the growth scare pushed a lot of people into the recession camp. As you know, on Friday, there were many people that declared we're already in recession because of the Sahm rule. And Claudia Sahm herself sort of walked back on the idea that this rule was meant to be broken. So I think that market expectations are much higher for recession risk. And I think as you reduce those odds, and I think a good claims report and a decent inflation report, that takes those probabilities down. And I think that's a boost for small caps. And again, at 10 times forward earnings, I think the risk reward is still really good here, even on a 1 year time frame.
It was rather remarkable from Wednesday's Fed news conference, where the chair was pretty positive on the state of where the economy is and even the labor market. And then by that Friday, we had decided that we were in a recession. Young Yu, I'd love to find out your views. What a crazy week it's been. So what are your takeaways here?
It has been quite a week, and it's great to be here, Scott. I think there are a few takeaways for this week. One takeaway is that even though we are seeing some economic softening, it's important to remember the first word in soft landing is soft. We don't think there's actual downside momentum building the economy, and we saw that punctuated by the weekly initial jobless claims number. And we think we'll see that in coming data as well, that we might see a bit of softness, but not down momentum. Even if you look at credit spreads, for example, yes, they widened a lot on Friday and Monday, but they've come back down a lot as well. And we think that's a sign of underlying health in the economy and underlying stability. So, we're in the camp that we see softness or choppiness for the next couple of months, but this is probably more a period to look for opportunities. And once we get past the election, once we get a few Fed rate cuts under our belts, maybe 100 basis points of cuts over the next couple of meetings, that the economy can really get back on track toward acceleration rather than softening or mixed data that we've seen.
I mean, after listening to that, Tom Lee is correct. I think they're all correct in their own ways. The only thing that really matters here is what's going on with the economy. How are recession risks getting priced into the markets? I think there is a large disparity in our markets between the S&P, the NASDAQ, to a lesser extent, the Dow. I think the markets, they're not even real at this point. Let's just be honest. The S&P is not a good barometer of what's happening in the markets. I think the headline S&P is so bifabricated with the large tech names that are really deemed recession resilient that there's only like a 5% odds of a recession baked into the headline S&P. Okay, so if we did go into recession, headline S&P could fall a lot. If you look at the Russell, or if you look at the equal weight S&P, or just look at interest rate sensitive or cyclically sensitive companies, there's more like a 65-70% chance of a recession already baked into those areas. That's why the Russell has lagged so much. for an example. So I think if we did go into some kind of slower economic period, you've already priced in a lot of that risk in those areas. So I think the S&P on a headline basis could take the decline even worse. We'll have to see. That's in the scenario that we actually do go into recession. If we don't go into a recession, if the data just looks soft, and it looks like things are kind of trending just soft, then I think Tom Lee could be correct. If we start to get some rate cuts and that starts to balance out some of the softness in data, you could see a pretty ferocious end of the year rally. I think it's far too soon to have your mind made up in one direction or the other. I'll be honest with you guys. I'm a little more skewed towards a hard landing. I'll let you in on a little secret. I work in a restaurant on the weekends because that's when it's busier. And I've worked at this restaurant for a long time now. I'm also a real estate agent. I own rental properties, but I like to do a little bit of everything. Also, working in the restaurant gets me out the house a lot, which is definitely a plus. And I love my coworkers. I serve at this restaurant, okay? I cooked at the restaurant a long time. I dishwashed at the restaurant for a small, short period in time. And I will tell you right now, that restaurant, even being in a tourist town, has gotten dramatically slower than last year and way slower than 2022. People are tipping less. They're sharing food more. Just from what I see in my day-to-day life, points towards recession. If the data does not show it, people feel it. I'll tell you that right now. It's an election year. There's tweaking being done to the data, and I think that's being generous. You could say outright it's being manipulated potentially. But what I see looks recessionary. And it looks like it's getting worse. It does not look like it is getting better. And that is what I find alarming. And that's just my personal insight to this, where maybe some of you guys may not be, associated with the restaurant crowd, the leisure hospitality area of the economy. A very large portion of this economy is leisure, travel, hospitality. And that sector, at least from what I can see, does not look good. So in conclusion of this video, let me know how you think about the economy right now. Where do you work? Are you busy right now? Are you, maybe busy but slower than years prior? Let me know what your experience is right now in the economy. I would love to hear that from you. Hit the like button as well as subscribe to the channel. Also, let me know if you're in the soft landing or hard landing camp. Again, I have not made up my mind about a hard landing or soft landing. I think the odds are much more like Jamie Dimon just said yesterday or 2 days ago. 35-40% chance of a soft landing means there's a 60-65% chance of a recession. I think that makes sense. The timing on this is difficult, and sentiment will fluctuate week by week, day by day, month by month, or even year by year. We may not go into an actual recession until a year from now. It could be the end of 2025 before we're in a recession. Now, if we're not in a recession by the end of 2025, then I think it's safe to say we've probably had a rolling recession and, well, already experienced that economic downturn nonetheless. So let me know what you think about this information down below in the comment section. Hit the like button and subscribe to the channel if you like this perspective, you like these market breakdown, and sometimes from here and there a bit of Tom Lee as well. You guys enjoy the rest of your day and your weekend. I will see you in the next one.